Hello guys, and welcome back to another training video. In today's video, we're going to be looking at candlestick formation. So price action candlestick setups. We're going to take a look at a few, actually two of the mainly popular price action setups. Now, following the progression that we're making so far, we've looked at market structure, understand that, there's a certain way the market moves. It tends to trend, going from one certain trend to another. It's always in one form of trend. And we also discussed that to give ourselves the best odds to succeed, we want to do our best to trade in the direction of the trend. So in a bullish market, we look to buy. And in the bearish markets, we look to sell. Now, we also looked at support and resistance and how we apply them properly in relationship to the structure of the market. We also looked at trend line. But note that those support resistance trend line, they give us an area to watch for potential opportunity. But just because price is getting to a support and the market is bullish doesn't mean that the support would hold. And it doesn't even give us an idea as to where to get in and how to manage our trades. Therefore, we need some sort of confirmation. There are lots of confirmation, and in most cases, a combination of them. Now, one of them is going to be price action system. So we're going to be looking at a number of price action candle setups, and then we'll see how we apply that in our trading. Okay. Now, well, the content of what we'll be running through is here. So candlesticks and the story detail. We'll look at candlesticks in a little bit. Not necessarily we'll discuss candlesticks, but we'll look at how we can interpret some of the structures or some of the patterns that they show, and how they serve as sign language to the markets, right? And then we'll consider two key candlestick formations that you should know how to enter and exit them based on those two setups. And we'll look at some examples in the markets, okay? So stay tuned. Now, candlesticks, right? We can learn a lot from the shape. At least we can deduce a lot from the shapes, the size, and sometimes a combination of two or more candlesticks. They can give us an insight into what is most likely going to occur in the market. So think about it this way. We don't know where price is going. We are trying to figure out what price will do so that we can take advantage of it before it happens. And so we need some sort of confirmation. We need to, one, understand the way the market works, as where market structure comes in. And then we also need to understand how to get involved and how to manage ourselves and not expose ourselves to too much risk, right? Now, candlesticks sometimes gives us an insight into the markets, right? In some cases. Now, so take, for example, a vehicle. So a vehicle runs on fuel. Obviously, if it's an electric vehicle, then it runs on battery. Whatever the case, you can, if you're driving your vehicle and you're running low on fuel, you have a sign on the dashboard, signify to you that you're running out of gas. Now, that sign where it starts, blinking, doesn't mean that you're exactly out of gas. Doesn't mean that the vehicle is going to stop at this point, but it's giving you a sign that you're running low. Now, if you ignore the sign, there's a good chance in no distant time, the vehicle will stop because you're out of fuel. But you can use the sign as the sign given to you in your dashboard as a hint that, okay, maybe it's time to refuel. That means this car wants to stop, right? In the same way, the market doesn't just move in a straight line. Like we've discussed, it moves in waves, and it's going up sometimes, it's coming down sometimes. And we take advantage of the markets when we're able to buy low and sell high. But most times, we need a reason to buy low and sell high. And as confirmation, candlesticks can add to the other things that we're learning to help us figure out possible areas and how to get involved. Now, each candle, shows you information as to what has happened in a specific period of time. So if you're looking at a 1 hour time frame, then every single candle in that chart represents 1 hour of trading. So if you pick a candle, for instance, to show you the open price, the close price, the high price, and the low price. And then sometimes the candle is bigger, sometimes the weeks of the candles are longer or farther or shorter or no week at all. When this occurs, depending on those setups, we can deduce something. At least we can make some sort of implication as to what is going on. And then depending on where it occurs, it can even have further credence. Now, let us consider some two common candlestick patterns. And we'll begin with the first one, which is a pin bar or a hammer, whichever you want to call it. So it's called a hammer like this. One over here, you can refer to it as a hammer, right? Because it kind of looks like a hammer. And then this, it's also an inverted hammer or a pin bar, whichever you want to call it. I don't care the name or how you pronounce it, just that you understand what it looks like and actually what story it's telling. So this green one is the bullish pin bar, and then this red one is the bearish pin bar. So this will be the hammer and this will be the inverted hammer. Now, but basically, what does this candle mean, right? Just what does this candle on itself, what does it mean? But what it means is this, that during the trading period, let's say this is a daily chart, right? Let's say this is a daily chart. During the day, the market opened here. This was the opening price down here, right? But then at some point during the day, there was a time when price went down as low as here. That means while the candle is still forming, there was a time when this was a big bearish candle. But eventually, buyers came in and pushed price and closed it here. At the point, price was even as high as this. So this shows that, well, markets open here, sellers gained, sellers were in control and pushed price down. But then buyers stepped in and forced price back up. So it's like a tug of war where initially one party was winning, but eventually it goes the other way. So like a football match where, the team, if a team scores one goal and then scores another goal and then they think they are winning, only for the opposing team to come back and score 3 to win the match, right? So that's kind of, that's basically the kind of way you should think about it. So that's what this candle is saying, that, well, buyers and sellers were in the tug of war. Sellers seem to be winning, but then buyers push price up and give sellers a run for their money. Now, the opposite will be true for the bearish pin bar or the inverted hammer. What it means is, well, price opened here at this was the opening price. At some point during the period, or during that, let's say this is a day or 1 hour chart, whatever, at some point during that period, there was a time price came as high as this. That means buyers pushed price up all the way to here. But then before the close of that period, sellers came in, forced price back down, even as low as here, but ended up closing down here. So the same way, the home team were winning, or the away team was winning, let's put it like this. And then eventually, before the match ends, the home team came back and take all 3 points. So that's exactly what a pin bar is telling you. That is a struggle between buyers and sellers, and eventually one party won. But you can see what happened, that there was a lot of volume, there was a lot of pressure to take price down, but the pressure was met by an even greater force to push price back up, right? Now, you can find hammers and pin bar anywhere within the charts, right? But then I'll tell you how you can apply them as confirmation, because just because you see a hammer in the chart or a pin bar in the chart doesn't mean price would go up or come down. But when you apply it with other confirmation, when you apply it properly, you can begin to give yourself an edge in the market. So let's proceed and look at what an example. As you can see here, price is pulling back, is pulling down, right? So now here's one thing I need to point out. So when you see let me go back up just a bit. Now, a bullish pin bar is a bullish sign. So that means a bullish pin bar is a sign that potentially price wants to go up, right? So if you see a bullish pin bar, think of it like a sign that potentially price wants to go up. And the bearish pin bar, this red one, is a sign that potentially price wants to come down. Okay. Now, just because you see a bullish pin bar doesn't mean price would go up. A bullish pin bar, or pin bars in general, are reversal candlestick setup. So what that means is they are telling you that, okay, wait, the current trend might change, not necessarily the overall trend, but let's say price is bearish, right? So price has been bearish into an area, and then you now find a bullish pin bar at an area of support. Now that pin bar could serve as a sign that potentially buyers want to hold this level. And if that's true, you'd find that price would begin to rise. Now, it doesn't necessarily need to rise all the way up, but it could offer opportunities for buying. And then the opposite would be for the bearish pin bar, where if price has been going up and at the level of resistance, right? At the level of resistance, you find, we have this bearish pin bar. That could be a sign that potentially sellers want to defend this area and take price down. Now, remember, resistance and support don't mean jack. They don't mean nothing except when applied in context, right? That means, like I always teach you, if you're looking at the market and the market is bullish, you're looking for buying opportunity. So you're looking for buying opportunity in the bullish market, and you're looking for selling opportunity in a bearish market. Well, what does that mean? That means that if the market is, let's say, bearish, for instance, or we're looking at the bearish market where price is been coming down. Now, remember, right? Remember that in a bearish market like this, we expect price to not just fall off the face of the earth, but we expect that price would make pullbacks. That's how the market works. It moves in waves. So therefore, if we find that the market is bearish, right, and then let's say price is coming back up like this. Now, this period here, this area here is telling us that, okay, well, because the price structure is bearish, right, we want to be looking for selling opportunity. Therefore, we are looking for selling opportunity where at possible resistance area. Now, it could be a trend line like so, it could be previous resistance or previous order blocks, whatever the case, but it's an area of resistance. And then let's say we find a pin bar, right? Now, that could serve as a possible sign that, well, it means that potentially buyers, that means these buyers here that were pushing price up in this particular region are getting exhausted, and sellers want to continue the overall direction. And so we could use that as confirmation to get involved selling to take price down. Okay, I hope that makes sense. Now, in this case, so you can see what this illustration here is showing that, well, price has been coming down. That's why you have these bearish setups. And then we have this pin bar. So this is a bullish pin bar, and it's followed by, a bullish market. Now, the market is not always going to present you with perfect setups like this, where it's always tops in and then we get this bounce. Sometimes it could get the pin bar, come down a little before going up, but that is serving as a sign that we are potentially looking at a bullish movement. So it's more like, just because you have a red light on your gas tank, it doesn't mean your vehicle will stop now. It could move a little bit before it stops, but that could be a sign that you need, that's going to stop very soon. Okay. Now, here is an example of the pinball in the chart. I'll go back to the live chart and we'll look at this again. So this is a chart for the Australian dollar against the New Zealand dollar. And you can see here that, well, the market obviously is in different phases. But I'm not going to look at, because this is candlestick setups, we're just looking at the candlesticks themselves, right? I'll try to apply them in context of market structure as well. So remember, within this framework here, the market is bearish, right? The market is bearish within this framework. Maybe if you zoom out and maybe look at the 1 month chart, this would have been maybe an overall bearish structure, where this is part of an overall bigger bearish structure. But within each of these setups here, you can see that there is a bullishness and a bearishness. Now, depending on the time frame you're trading this on, you'd want to keep that in mind. Now, so let's looking at this, you could see some highlighted ones here, right? Some highlighted areas here. You could see, for example, this, right? Now, what do you find there? What does that look like? Now, another key points to also let you know on is the pin bar itself. It doesn't matter what is the color of the candle. So what I mean is, a pin bar can be bullish, but the candle itself is bearish. So what I mean is, let's say this is a candle, right? This is a bearish pin bar, right? So that's the week and something like this. Now, if this candle is green, that means it's, price opened here and closed here. It doesn't change this from being a bullish pin bar. Even if the candle itself is red, that means price opened here and closed here. The important point is that you can see the pressure, the exchange, the tug of war between buyers and seller, and you can tell the story by looking at the wick. That means the most important points of a pin bar are the wick. So for what are the criteria for a bullish pin bar? Well, for a bullish pin bar, that means it's a bullish pin bar. For a bullish pin bar, the bottom wick should be at least 2 times more than the size of the body. So the bottom wick should be 2 times bigger, at least 2 times more than the size of the body. And then it should also be a lot bigger, and the body of the candle should not be, now there's no exact rule as to how you would consider a pin bar, but this is just general overview, my perspective of if, for example, the tip of the candle, the upper wick is like this is not a bullish pin bar. The upper wick needs to be small, at least compared to the body of the candle and compared to the lower wick, right? So this is not a bullish pin bar, right? But this, right, is let me say something like this, is a bullish pin bar, irrespective of the color of the candle, right? And for a bearish pin bar, the upper wick needs to be at least 2 times more than the body of the candle, and the lower wick needs to be smaller, at least not bigger than the upper wick, and also not much bigger than the lower wick. I hope that makes sense. Okay. Now, let me erase this so we can see space. Now you can see that, well, price is appreciating, so it meets first criteria. The market is pushing upward, and then we find actually two bearish pin bar. You can see one of them is a green and the other is red. That means, but it's still considered bearish pin bar because of the wicks. You can see the wicks price spiked up. That means buyers pushed price up, sellers refused and pushed price down. Again, buyers pushed price up and sellers refused and pushed price down, showing that there's a willingness for sellers to defend that area. And what happened? Well, you can see the follow through is the market fell off. Now, one thing that is significant is you can see prior to that, the market has been bearish. And then we had this push up. And so overall, this would have been a level of resistance in a bearish market. And we could have been able to take advantage of that and sell off. Now, this might not be a prime example, but you can get the idea. Pin bars, of course, and they serve as potential reversal patterns. Again, you can see another bearish pin bar here in which it made price to drop. And then you can see another bullish pin bar here that served as confirmation, right, to get price to rise. Okay, so that's on bullish pin bars. Don't worry, as you use them, as we apply them in more classes or trainings, it will make more and more sense. And then obviously you can always rewatch this to get more drift out of it. Okay, now the next type of candlestick pattern we're going to discuss is the engulfing candlestick pattern. Now, just like the bullish pin bar or the bullish, just like the pin bar, the engulfing candle can be either bullish or bearish. Now, unlike the pin bar, which is a one candles formation, the engulfing pattern or engulfing candle requires at least 2 candles. So as the name implies, it's one candle that completely engulfs the other candle. Now, similar to a pin bar, it is a reversal pattern, meaning if price is bearish and then you find a bullish engulfing at a level of support, right? Let's say price is bearish, for instance, and then we find, and maybe the overall structure might be bullish. So price is bullish and then retracing. And it's this retracement we're looking to trade to continue the overall structure. And this is, for example, a level of support or some sort of trend line. And then we have a bullish engulfing. Now, what is a bullish engulfing? It's one candle. So a bullish engulfing is a combination of 2 candles. The first one being a bearish candle, right? That is completely covered. So the body of the candle, so you can see how this candle now, most cases you would have that the wick, even the wick of the candle should be covered, right? Now, in most cases, a bullish engulfing is one where a bearish candle, right? So you have a candle that is bearish. And then we have another candle that the candle that follows it is bullish and is bigger way bigger than it and completely covers the body of the candle, even the wicks, right? Now it engulfs, just as the name implies, it engulfs the other candle. So it's a bullish engulfing. A bearish engulfing is in a situation where price has been bullish, so price has been going up, at least within the structure, and then we have a setup where we have another bullish candle followed by a bearish candle that is much bigger than it, and this bearish candle completely engulfs the previous bullish candle, and this two setup combined is called or considered a bearish engulfing candlestick. Okay, so that's how you identify them. And now let's look at this is classic bullish engulfing, right? A bearish candle that is engulfed by a bullish candle, much bigger than it. And better, this is much valid if we're looking at a level of support or an area of demand. And then a bearish engulfing is, you can see a bullish candle that is completely engulfed by a bearish candle in an area of supply or resistance, and then price drops. So this is, basically the just an analogy of the engulfing bar. Now let's look at the chart again. Let's look at the chart again of an engulfing candle. Right, you can see that, well, now this is a bullish market, probably in the overall context, this might be a bearish market and price is just retracing, but you can see an area of, in this case, possible resistance where, well, first of all, you can see we had a bearish pin bar here, right? Within that same area, you can see we have another bearish engulfing candle here. You can see this candle, which is bullish, and then we have this candle, which is bearish, that completely covers that candle, and that serves as the sign for reversal. And what happened? Well, price dropped off, and we could have taken advantage of that. So now what we'll do is I'll take you over to the chart, and then we'll look at, okay, what are some examples of this bearish pin bar, bullish pin bar, bearish engulfing, bullish engulfing, and how we could enter trades based on them. Okay. Okay, so here we are on our chart. So this is the chart for what chart? This is AUD card. Now remember, just like everything I teach you, you can apply on every single instrument, every time frame. You can apply the same concept because that's the beauty of the Forex market. The market is fractal, where the 1 minute chart, and if I take away the time frame and show you a 1 minute chart, you wouldn't be able to tell the difference if it's a 1 minute or a 1 month chart, right? Because the market moves in the same way. It moves in structures. It goes from uptrend, it's downtrend, or a sideways trend, and you'll still be able to find areas of demand, supply, and then you will also be able to trade it. Now, so we're looking at the chart of AUD card for this illustration, and we're going to just try and see if we can spot some bearish pin bar that we could have traded, bullish pin bar, and engulfing candles that we could take advantage of. So first things first, the main point here is looking for setups for those candlestick patterns and trading them, but I'll try and apply them to the concept of market structure. Okay, so based on our market structure analogy, we say, well, we want to see the structure of the market. What's the structure of the market? If the market is bearish, we want to look for selling opportunity. If the market is bullish, we want to look for, well, buying opportunity. So let's start from here. We can start from anywhere. We can even start from here. So let's take this for instance, right? So price is, let me see. Well, overall, price is pushing up. Price is bullish, right? You can see the market is making higher highs. Yeah, we had this, what I say, flag pattern here, or some sort of consolidation pattern here, which you would understand as you get further into this when you start looking at Dow's theories of, Dow's theories on Elliott wave and all of those things. But this market is bullish, and then you can see price drops down. So notice this, price drops down to a previous area of, what would this look like? Well, this is what you call a support. And we're saying in the bullish market, we're looking for buying opportunities. So price, is coming back to an area, right? So price is coming, let me see if I can get it replayed too. The price is coming back to an area of support, because at this point, we're looking at this market, the market is bullish, right? You can tell the market is bullish. So we're looking at this and we're saying, what do we do next? So let's play price. Let me play that 1 speed. And we decide, okay, now remember, like I mentioned, profitable trading is mostly about patience. You've identified the structure, you've identified an area you're interested in, And just because you identified an area doesn't mean the market would even get there. So many times you wait for nothing. It's part of the game. You move on. You don't try to force that, oh, this has to get there. It doesn't have to do any of those. But in this case, we're waiting and price is pulling back to a level that we've identified as support or as demand zone, and in this case, even possibly an order block. And then we're watching what we want to do. Just because we have this level in mind doesn't mean we'll just place a pending order to buy. We want confirmation to get involved. And confirmation in this case can be some sort of bearish, some sort of candlestick formation. So because we're looking for bullish signs, right? Remember, because we're looking at a bullish market. Let's continue playing price, and the market continues. It taps into the area, breaks below it, and breaks back above it. So you could see sellers push price down, close below it, and instantly price forced its way back up. Now, this is a sign. This is not a guarantee, but this is a sign that it seems buyers are refusing to let sellers have their way and take price below here. Now, we can take this and use this as a reason. Now, this can be, you can have multiple confirmation, but for now, we can take this and use it as a reason to get involved. Now, the question is, how do you trade this? Because remember, before you get into any position, you want to have two things in mind. Three things actually. Where do I enter? And how do I enter? Where do I exit for stop? That's in case I'm wrong, for loss. And where do I exit for profits in case I'm right? So now we've seen the bullish setup. We've seen the bullish price action setup. How do we trade this? Now, there are two ways to go about this. There are two ways. They both have their pros and cons. The first one will be, once you see the setup, you can get involved in a buy, because this is the buy setup now. So once the setup, you see it and you like it, you get involved. You can buy at the close of that candle. Now, one thing to notice, you want to wait for the candle to close. So this is a daily chart. The candle has to close. It can be forming a bullish pin bar and end up closing back. So you have to wait for the candle to close. So your entry can be at the close of that candle. That means at the beginning of the next candle. And then your stop loss just below the low. So depending on you can be 5, 10 pips. Remember, you want to do your own research. You want to study the market, see how it reacts in the past, okay? And then obviously you can target it 2 times. Maybe your risk to reward might be to the next twice. If you have a risk to reward ratio, maybe 1:2, or maybe you're targeting the next area or key level, because since it's a bullish market, there's a good chance price will want to come back up to take out resistance. Okay, so you can target that resistance area. And then that's the first entry setup. The second entry setup is that some other times when we have a price action setup, the market tends to pull back down. So the market might not immediately start to go up or start to react. We could have a situation where price first comes back down before going up, right? Now, in that case, you can just have your entry, and let's say halfway of the setup, so 50% of that, you can just put your entry there and still do the same thing. Now, the advantage of the first one, so this is what the first one would look like. And this is what the second one would look like. Now, you can see here the advantage of the second one, because, well, your risk is much lower and your potential reward is much higher. Well, the disadvantage is sometimes price doesn't pull back down. So it's entirely up to you to decide how you want to approach it in each individual setup, okay? So let's play and see. We already know how this one goes. But when price begins to move up, right? Let's see, does it come back and give us a 50% entry? Yes, it did. So in this case, if you waited for price to come up here, you'd have gotten triggered, and obviously you'd have had better risk to reward ratio, but doesn't really matter. And then, well, risk to reward ratio matters. But you get the drift. Sometimes it doesn't pull back, sometimes it does. And in this case, well, price begins to move. Do we hit our full TP? Maybe we do, maybe we don't. I think we did. I remember the chart. Let's speed this up a little bit and see if we hit full TP. Now, remember, you can always close your profits at certain areas, and yeah, we get our full TP hits. Now, also another thing to note is this. You're not going to catch every setup, but anytime you look at the market, there's going to be some sort of structure and some sort of plan that you can make. Now, even if you come back and this has moved, you can not enter, so you don't just jump in. you can still understanding that, okay, we are now in a bullish setups, and maybe on a smaller time frame, still try to look for the intermediate setups, right? So, but let's just keep that on the side and continue to move. So we have this trade out of the way. It hits our full TP for in both cases, and we continue to move. Now, remember, the market is still bullish. Why? Because the structure of the market is bullish. I don't want to spend too much time here. Now we're still looking for what buying opportunity. Why? Because the market is bullish. Where are we looking for this opportunity? Well, this is the low, the most recent low. And there are probably areas of support. Remember, because we're looking for bullish opportunity, areas of support that we could potentially look to buy from. So this area here, something like this, would be one to watch. Down here, obviously, and price may or may not get there. But the point is, if price gets there, we want to now start looking for some sort of confirmation. In this case, because we're learning price action, we're looking for a bullish engulfing or a bullish pin bar. So we keep going. But price doesn't come back down. Okay, now here would be a situation of where it fails, right? Now, price came back, tapped into maybe this area we're watching, but I'll tell you why this would not be invalid, because price had broken above, but let's just assume we did. This was also a bullish engulfing that failed, because if we're taking this one, would have been a loss. Now, remember what I always tell you, the goal is not to win all your trades. The goal is to be profitable, have an edge in the market. So in this case, let's call this a loss. Right? But remember, in the first one, we made about 1:5. So we made, okay, let me just take 1:2.8 as 1:3. In this one, we lost 1%. So here we made 2.8%. Here we lost 1%. So let's keep going. And let's play price. And price keeps dropping. Now, you also need to understand, pay attention to understand when the setup has changed, right? Now, I remember what I tell you, the market is not always going to reach think of them as zones, as regions, not exactly as actual lines. Now, this is a bullish pin bar, right? This right here is a bullish pin bar. And I've explained engulfing. How do you trade pin bar? Well, for a pin bar, the same way, you can, once you find the pin bar at an area that you're interested in, you can enter at the close of the candle or halfway through it. So in this case, let's say we enter at the close of the candle and we target, our stop loss would be just below the low of the pin bar. So if I can just draw this, right? So our stop loss would be just below the low of the pin bar, and our targets can be maybe this previous area here. It can also be maybe a 2-to, you can have a 2-to-1 risk to reward ratio, or 1:2 risk to reward ratio. And even if you're targeting this place, you can close partial profits at maybe 1:2, right? In this case, you probably would have taken some profit. You could see price tapped in and rejected and moved. So essentially, this is how you approach. This is basically the pin bar setups. You can identify them on the chart, how to take advantage of them when they do occur, and how to trade them. Now, like I always teach you, always mention, you want to apply it with structure in mind, right? Just because you see a bullish pin bar, you want to see the structure before that and see, is it bearish, is it bullish? If you see a bullish pin bar in a bearish structure, that's not a good setup to trade, right? Just as if you see a bullish pin bar in a bearish setup, not a good system to trade. You can see the market became bearish here when we had this break below here. So you probably shouldn't be trading this, but I just needed an example to show you bullish pin bars or pin bars in general, right? Same way, the market is now bearish. You can see clearly price is making lower lows and lower highs. So we're looking for selling opportunities in this market. So we're looking for bearish pin bar and bearish engulfing. So let's see if we find any before we call it a wrap. So price is pulling back up. This area will be interesting. Now we saw one. Now this is what you can see the market is bearish. We have this here. Now, this is a two combination. We have a bearish pin bar that also has also become part of a bearish engulfing. So even if you didn't trade the bearish pin bar, you could have at least traded the bearish engulfing. This would be a sell in this case, where we sell from here, our stop loss just above here, and I'll take profits. Maybe this low, but you can obviously take partial profit because this is a daily time frame as price begins to move. So that's exactly a brief rundown on candlestick patterns and how you can apply them to your trading. What you want to do, like I always mention, is practice, because that's the only way you get you get better, you get good in this system. Okay, so I hope you enjoyed the training. On to the next one. Until then, keep practicing, stay safe, and cheers.